Hello and welcome to the first lesson in this more advanced valuation and DCF case study based on Jazz Pharmaceuticals. Now you can take a look at the case study document here, which is pretty short, only about 2 pages, and most of the scenario is just described on the first page. A large portion is taken up by this image as well. So it's a pretty short document and the case study is quite open-ended. The basic idea is that we're looking at this pharmaceutical company that is about to lose about 75% or as much as 75% of its revenue over the next few years. They're trying to replace it with another similar drug. They're also trying to add new drugs to their pipeline through acquisitions and internal development. And we want to see whether the company is overvalued, undervalued, or valued appropriately based on that. And then at the end, we will also draft a short stock pitch for the company recommending for or against investment in its stock. Let's talk a little bit about what this case study is all about. We'll go through and talk about the suggested strategy here and the company's business model. And then we'll close by going through an Excel file and entering some of the key information that we'll need to complete the rest of this. So the first main objective here is that these lessons explain how to read and interpret a company's documents, do some outside research, and build your own model for it. Now, we're not going to perform all the data entry on screen due to the time required, but we will explain it. So it's not going to be quite as step-by-step as some case studies here, because we just don't have time with something as complicated as this. It would probably take 50 to 60 hours just to enter all the data, and I don't want to slow down the case study and let it drag on that much. We will be looking at a lot of documents, everything from the company's 10K annual report to the 10Q interim report, to their most recent corporate presentation as of the time of this case study. So we will be using plenty of data, but we're just not going to be entering all of it manually on screen. The second objective here will be to teach you how to find and enter information and adjust it for comparable public companies and precedent transactions. This process is known as spreading the comps, and it is very tedious and annoying, but sometimes you do need it. This is much more of an on-the-job topic than a case study topic, and so I'm going to mark all these lessons optional because they have almost no relevancy if you're just preparing for interviews or modeling tests or case studies. So in short, the first segment of the lessons in this module will be about how to research the company, do some outside research, look at their filings, and create free cash flow projections for it. The second segment, which is optional, is all about how to find information for the public comps and precedent transactions. There's a little bit about how to screen for them as well, but that's quite simple if you've already made it this far and you've seen the other examples in this course. And then the third segment of the lessons here will be about more advanced WACC, weighted average cost of capital, and DCF features and how to create some model summaries. You don't need to do anything in this third segment to pass a case study or a modeling test, but it could come up, and depending on the company you're analyzing, some of these may be useful. So I wouldn't say this is as optional as the second segment, but if you're pressed for time, definitely focus on the first segment of the lessons here because these will be the most helpful in terms of your own case studies and modeling tests. Here's the lesson outline. I'm going to start in part 1 by discussing the biotech and pharmaceutical business model. Then we'll go into the recommended approach for this case study and go through some initial thoughts on the best way to tackle it. We'll talk about scenarios versus toggles here, 2 different ways to express uncertainty in models, the trade-offs, and which one is appropriate in this case. And then in part 4, we will go into Excel and start entering some of the components of unlevered free cash flow, similar to what we did in some of the simpler valuation case studies on this site. Let's go to part 1 and talk about the business model of pharmaceutical companies first. There are 2 main types of companies in this sector. One sells what are known as branded or brand name drugs, and then the other sells what are known as generics or generic drugs. Branded drugs are protected by exclusivity and patents that limit competition for a certain number of years. And so as a result, companies can charge very high prices because there is no competition. They're often the only drug for a specific illness or disease, or at least the only one that's viable in certain countries. Now, the argument for this is that it could take years or decades to develop drugs. They tend to be very expensive. You have to do all the clinical trials, all the testing. And so companies need to be compensated for assuming that risk. And so they are rewarded with this time-limited monopoly. The other reason why this works is because in most countries, consumers are not paying for these drugs directly. Even if a drug costs, say, $50,000 or $100,000 a year, insurance companies